Hei, hyvää iltapäivää. Minä olen Kaisu Christie Cognizantilta. Cognizant on 22-vuotias startup, jolla on 250 000 ihmistä maailmanlaajuisesti. Mä oon tänään puhumassa teille Future of Money, eli mitä raha tarkoittaa. I was meant to do this in English. Gosh, well, change on the fly. I'm going to talk to you about future of money and what it means for customers and how they perceive money, and what it actually then means for banks and like people like you, how to take those ideas forward. But before we go into the research that I'm going to talk to you about, I'm going to do a bit of exercise with you. I'm going to ask you, what is your relationship with money? What do you actually know about your own finances? I want you to think about a few questions. Do you know how many bank accounts you have and how much money you have on those bank accounts? Just a number. Do you know? No? Do you know how many loans you have? How many credit cards you have? How many borrowings you have from your friends and family, and what that number accumulates to? No. Do you know how many loyalty cards you have, frequent flyer points, whatever they are? And do you know the monetary value and what you could do with those funds as well? Do you know what insurances you have for yourself, for your family, life insurances, health insurances, and maybe what gaps you have? And what if you don't have an insurance? What could happen to you or your family and to your financial well-being if those insurances wouldn't be in place? Do you know what investments you have? How many assets you have? And do you actually know if they would take a hit of 20% tonight in long term, what it would mean for your financial well-being? Does it worry you or your family? Do you know what your pension looks like today? How much pension you've already accumulated? Do you know how much pension you will have when you retire? Or when can you afford to retire, if you can afford to retire? What would happen to you today if a sudden accident, maybe a divorce, maybe even death would occur? What would happen to your family's finances? Would they be looked after? Would you be looked after? And what it would mean to your financial life for the rest of your life and for the rest of their life. Does that make you worried if lots of the answers were no? Well, money can be stressful, and that's what I'm going to talk about a little bit. When Cognizant and Red Associates started to think about future of money and what it means, we scored hundreds of reports that are out there talking about the future of the finance. But what we found, a majority of them talks about the same thing. They went and asked consumers, what do you think future of finance is, the future of money is? And it was one of those Henry Ford questions. Everybody said, well, we just want to have a faster horse. So instead of asking the horse question, we actually set up a group of anthropologists to talk to people, to follow people. And we did a study in the United States, in Germany, and in UK, where we followed about 100 odd people in their day-to-day lives. We spoke with them, with their families, with their friends, with their financial advisors, and we observed them in situations where they handled their daily finances or discussions about their finances with their banks and with their friends. We then conducted a survey about 3,000 consumers around Europe and in the United States and asked similar type of questions. We also spoke to industry leaders, financial industry executives, fintech thought leaders, startup companies, and academics who research this area. And very interesting things started to come up. The biggest worry people had in their lives, and this came from the interviews and the surveys and when we observed people, biggest stress in their life is not their health, it's not their relationships, it's not terrorism, it's money, it's their finances. That was the number one thing that most people said what worries them most in life. Most people didn't know how much retirement funds they had when they could retire, or if they could retire. And this was particularly true in states where the social security system isn't as good as here in Finland or in the Nordic countries. A lot of them were worried about the advice they couldn't give to their children or support they couldn't give to their children for their financial well-being. They felt like they were incompetent parents, and that worried them. And when we asked them, How can banks help? They said, well, they don't. We asked them a question. If we gave you $1 million or €1 million, depending on the country we were in, or £1 million, would you go for your bank for advice how to use that? 70% of them said no. Banks don't get me. That's what they told us. When we looked at this study and the research, it showed two really interesting facts. The biggest difference is how people perceive money is not necessarily by their wealth status, it's actually by gender, age, and their lifestyle flexibility. Financial executives were agreed with us that men and women perceive money differently. Women, people like myself, stress more about money than men. And there's a lot of studies that tell us that females are the primary decision makers when it comes to major purchases, including financial purchases at home. And when the woman stresses, decision doesn't get made, it gets postponed, or it gets revisited often. There's the one interesting finding. Other interesting finding, which is linked to the upcoming millennials that Julian was talking about, the 75% of the millennials will have be the workforce of the future. They are becoming more and more what we call fluid lifestyles. They change their jobs much more often. They take career breaks. They do gig work. They change countries. They change jobs. They change industries. They treat their money in a very digital way. They are the least loyal customers you have, and they stress money more than people who have fixed lifestyle, who stay put, same job, same industry, same town, same country. But those fluid lifestyles are the workforce of the future. And they told us that currently the banks can't understand their choices, and there's no services that they seem to be getting them to provide the right services for them. So I'm going to tell a story about Alice before I go into what money meant for people, what the research showed us. Alice is a 28-year-old healthcare worker in London. She's pretty well off. She earns about £80,000 a year, which is a pretty good salary for a 20-year-old Londoner, I think. But she had to go for her parents to borrow money from them to a down payment for her flat. At the same time, she uses her credit card quite freely for trips to Italy with her girlfriends. She goes and shops on the Oxford Street every second weekend, goes parties, and cracks up her credit card. Just spends and spends and spends. But at the same time, every week she transports money from herself to her mother's account for safekeeping, for emergencies, because she doesn't trust herself not to touch that money, so she gives it for her mother for safekeeping. She doesn't see her pension that her employer pays her as her retirement plan, because she doesn't trust the financial system, because well, look at what they did for her parents. Their pension funds went down. Instead, she considers her flat, which she's still paying the mortgage off, her pension plan. But she hadn't thought at all what would happen if yet another housing bubble would come and she would lose the asset that she has under her, and what it would mean. This example tells fundamentally the misalignment of what people have in their monies. There's money that they spend day to day, but they don't seem to be linking into the money that they need to have in the future. So there's also another linkage that Alice and the people like her were telling us, that banks talk about products, whereas people talk about purposes for their money. So again, in the case of Alice, she has vault money, money for safekeeping. She doesn't call it savings account, she calls it vault money. It has a purpose. She has the spending money, the experimental money. Again, banks don't have a word for it. And then she has the asset and her future money, which has a different name for her, because they have a meaning for her. It's not a product, it's a purpose and a meaning. Fundamentally, there are two modes of money as well we find in the research. There is slow money and fast money. And this is where it gets exciting. Fast money we have every day. Fast money, we have products today. Fast money is your savings account, your cash, your payments, your credit cards, and this is where digitization has taken over. It's easy for me to transfer money from me to you via Siirto or mobile pay or Pivo or one of these mobile digital wallets we already have in place. But they're mostly on the moment, on the spot, very transactional, and they are exchanged for services and on the spot and products. The other fundamental type of money and mode of money is the slow money, and that's what banks have names for as well. We have insurances, we have pensions, we have investments, we have assets, and this is the money that people struggle with. It's really difficult to comprehend this type of money that doesn't exist in now. And these are the services which we haven't digitized and haven't made yet easy for people to understand. And more importantly, what is missing is the linkage between the quick money, the digitized money we've already done, and the slow money, and how they are brought together. So slow money is the one. So I'll give you an example of what I mean. So I took a life insurance. So I lived abroad. I've just come back to Finland, and I took a life insurance there because I needed some future security. And when I asked my banker, can you please explain how my life insurance and health insurance will contribute to my future well-being and my goals, he sent me a 100-page PDF document on an email. Now that's not very, sensible. And he couldn't explain that to me either. It's probably written by a lawyer. Sorry for any lawyers in the audience. But I consider myself financially savvy. I work in finance industry for years, but I just can't make the connection. What if it would make easier for me? Another example was about Anthony, a guy who we followed in London and who we went to meet his financial advisor. He wanted to have a private pension savings account. He'd been with the same bank since he graduated, so over 20 years. He had all his accounts in the bank. He had all his credit cards, all his mortgages, everything in the bank. We sat down with him and the bank advisor, and the bank advisor started asking all these questions from Anthony. Information that the bank already had about Anthony. They had more information about Anthony's finances than Anthony did, yet they didn't use it at all, and this is very common. This is where it comes into picture. When we ask people, how do you perceive your relationship with bank? They said it's very transactional, because we made the transactional banking very easy for them. People say it's money in and money out. It's a bit like in an ATM machine, you just put money in and you take money out. It's that easy. But when they struggle with the slow money. They struggle with the meaning and the understanding and the appreciation of banks have about their finances and how they can serve them. We need to think about how we can start navigating money between those two components, because that's what people told us they need. That's what people told us they want. So in order for banks to move from this utility transactional relationship with people, you have to start thinking about how to meet the needs of the slow money and how to combine those two. So you might think, well, who's this crazy lady talking about emotions and feelings and love your customer? Where are the numbers? Well, here are the numbers. I know there's some KPMG and Deloitte people in the audience, so I have to show a numbers page as well. We estimate that if you implement these strategies into your banks and financial institutions, we are looking at about 14% uplift opportunity in your revenues. And most of these numbers, most of this gain comes your additional revenue. Biggest effect, well, I haven't put the numbers in there, is from actually reducing your customer churn. So providing those slow money products for your existing customers makes them more stickier, makes them leave your bank less and less. We call this slow money lock-in. The other one is actually being able to provide these type of products for customers who don't have them, so increasing share of wallet of your customers when you can do it properly. And thirdly, looking at those synergies like I spoke about the fast and slow money. So let me give you an example what kind of use case or product that would look like. So my husband is in the audience and he knows I have a penchant and a bit of a vice of buying shoes. What if every time I buy shoes, I would set a rule to say, My bank knows that I'm saving for retirement, I have an investment plan, but every time I do fast money purchase, buy a pair of shoes, €5 from that purchase would go towards my investment fund. Well, that's step one. Wouldn't it be cool if once a month or once a quarter, I would get a real reminder from my bank saying, hey Kaisu, well done. You've saved an additional €100 or €1,000, depending on how expensive the shoes were, towards your investment fund, which means that when you retire in, what's the retirement rate in Finland now? 68? You will have extra, whatever money in your account. Or maybe if you're a really good girl, save a bit more and you can retire a year earlier. Now that would be meaningful for me regularly, and that would encourage me to buy more products. I wouldn't call them products, but do that saving better, and you would sell me more products. The other side of things comes from the cost reduction side. And one of the benefits, which again Julian spoke about, is advisory and digitalization of your services. And this is again where the slow money component can be beneficial. We also estimate that there's a benefit of knowing your customer better that actually reduces your losses in your loans when you start profiling your customers and their behaviors better. So what do you need to do in order to get this 14% uplift or anything above that or below that even? We think that you have to really understand the people you serve. You have to look for those unique, meaningful ways to serving your customer and their needs. We've published a research paper, so my email will be in the end. So if you are interested in getting it, just email me and I'll send it to you. We have recommended 5 things that you should do to implement these ones. I'm going to talk to 2 of them now. One of them is activating your data. And I'm sure there'll be people who've spoken about it yesterday, speaking today, but really data is the king. You have to find enough information about your customer, not just find it and collate it, but actually really mine it and turn it into actions in every single interaction you have with that customer. And secondly, use that information and data with your customer and for them as well. So really activating your data and get it from anywhere you can, because the more data you have and the more you actually utilize it, the better it is. The second thing is digitizing the advice. We've seen it in Finland. Like I said, I work overseas. Number of branches are closing. So that personal advice is disappearing. And people also prefer to do things digitally. So how you digitize advice, but not just digitizing the robots, that's very unmeaningful for me and I feel like a number. But make it meaningful, make it for me, and make it me feel that I have a choice, that I can co-produce with the advice I get the result that I want for myself across these 2 things. So activating your data and digitizing the advice in a way that's meaningful for me. So you really need to help piece the big picture of together. So now when we've spoken about the buckets of data and the fast and the slow money, go back to the first question. If I gave you $1 million, what would you do with that money? Would you put it into the fast money bucket and buy yourself that Porsche that you always wanted? Or would you put it into the slow money bucket, and what would you do with it? Would you now go into your bank or into your financial institution and ask them for advice? Do you think you would get relevant advice? Would you trust that? And if you wouldn't, and you work for the said bank, what would you do about it? What options do you have to execute in a way that you yourself as a customer could trust your own bank to provide advice for your own financial future? Like I said, I work for Cognizant, and this is an area that I work in. We work with 9 of the 10 largest European banks to look into the future and see what people want with their money. What we found is you really have to start thinking about your customer in a much more meaningful way and looking at their needs first. We believe that looking into the future, you have to imagine being your customer's shoes. In order to be more digital, you have to be more human. And that's where Future of Money starts. Thank you very much.